Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
In today's episode, you'll learn about, first, today's US market review. Markets surge on a dovish Fed surprise, but a crisis looms as consumer confidence plummets. Is this a sentiment-fueled trap or the start of a real Santa rally? Second, AI bombshell. MIT study reveals $1.2 trillion in wages immediately vulnerable, triggering a white-collar crisis. High-profile tech layoffs are just the tip of the iceberg. Which safe jobs are now on the chopping block? And where is the hidden bloodbath happening? Finally, Tesla's European massacre. Sales plummet 48.5% as VW surges 78%, igniting an EV price war. With its core business under siege, Tesla is betting the farm on a high-stakes robotaxi gamble. Is this a visionary pivot or a desperate move that could sink the company? Warning! The markets are on fire today as the Fed's dovish surprise sends shockwaves through Wall Street. The S&P 500 soared to 6,800, 12.61, up 0.69%, while the Dow Jones rocketed 1.41% higher. But listen up, this rally is sentiment-driven and not fundamentally backed, so don't get caught in the euphoria without a plan. Here's what's happening. The Federal Reserve has flipped the script with an 85% probability of a December rate cut following dovish remarks from New York Fed President John Williams. This has shifted market dynamics dramatically, sending investors rushing into equities. But here's the catch. Consumer confidence has plummeted to its lowest level since April, a clear warning that this rally might be a house of cards. The VIX has dropped 9.6% to 18.56, indicating compressed volatility and potential complacency. I'm telling you, while the party is raging on Wall Street, you'd better watch your step. Let's break down the three layers of today's market impact. First, on the policy front, Williams' dovish statement has essentially signaled that the Fed is ready to ease the monetary conditions further. The 10-year Treasury yield falling to 4.01% confirms this. But remember, historically, such policy shifts have been the calm before a storm if the economic fundamentals don't support the optimism. Second, money flows are tilting heavily into cyclical and economically sensitive sectors, as evidenced by the Dow's strong performance. However, this rotation might be premature if the consumer confidence data leads to a spending slowdown. Third, valuations are getting stretched in certain sectors. The Nasdaq's more modest 0.67% gain versus the Dow's 1.41% suggests that tech stocks might be losing their luster, with investors cautious about high P divided by E ratios amidst rising rate cut optimism. Now, for the strategy, I'm telling you, cut your exposure to mature tech stocks like Microsoft and Apple now, while increasing your positions in financials and AI infrastructure plays. The financial sector, represented by the XLF, is set to benefit from stable rate environments, while AI-driven companies like Broadcom, up 3.28%, are riding the AI wave, making them attractive targets. In sector news, healthcare and consumer discretionary led the charge today, with XLV up 2.3% and XLY climbing 2.1%. Broadcom and Apple were standout performers, with Broadcom's AI infrastructure focus pushing it higher and Apple hitting new all-time highs, despite the broader tech sector's cautious stance. On the flip side, Meta Platforms bucked the trend with a 0.36% decline, signaling investor caution about ad revenue-dependent tech stocks in a potentially softening economy. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. In the short term, 1 to 2 weeks, act now and reduce your tech exposure by 15 to 20%, redeploying into financials, XLF, and AI infrastructure, AVGo, NVD. Target $42 for XLF, with stop loss set at $28.5. For medium term, 1 to 3 months, positioning overweight financials and underweight discretionary consumer stocks, which might face headwinds from declining consumer confidence. Hedge your bets by increasing defensive positions in utilities, XLU and consumer staples, XLP, offering stability against potential market turbulence. Use SPY. Put options for downside protection. Advanced investors should consider a 5% out of the money strategy for defined risk control. Remember, time's ticking. The next big catalyst is the December Federal Reserve meeting, and you need to be ready for whatever Powell throws at us. Whether it's a cut or a pause, Your portfolio needs to be agile and prepared for both upswings and downturns. Now let's dive deep into today's critical market dynamics and explore what's driving these shocking moves. Let's start with a single statistic that might just change your entire perspective on AI's impact. According to a new MIT study, 11.7% of the US workforce could be replaced by artificial intelligence right now. That's not a future forecast. That is the current capability. We're talking about $1.2 trillion in wages across finance, healthcare, and professional services that are immediately vulnerable to automation. But that's not the whole picture. The real turning point is understanding where this impact is hitting hardest. According to the researchers, those high-profile job cuts are just the tip of the iceberg, representing a mere $211 billion of the total risk. The true exposure, the bulk of that $1.2 trillion, lies beneath the surface. It's in the routine functions often overlooked in automation forecasts, human resources, logistics, finance, and office administration jobs spread across the entire country. You might remember us talking about the AI capital expenditure supercycle and how compute power is consolidating. Today's study is the flip side of that coin, the immediate demand shock on everyday business functions far beyond the tech sector. Actually, this submerged risk is triggering a slow burn crisis in white-collar employment. The biggest impact isn't on coders, but on the vast number of administrative and professional service roles that form the backbone of most companies. Research shows that as many as 80% of secretaries and administrative assistants are at risk. As companies automate these routine tasks to cut costs, it could fundamentally change their entire cost structure and even reduce the demand for commercial real estate, as fewer administrative staff means less need for office space. This isn't speculation. The findings come from a massive simulation tool called the Iceberg Index, a digital twin of the American labor market created by MIT and Oak Ridge National Laboratory. It maps 151 million workers and more than 32,000 skills to measure exactly where today's AI systems can take over human tasks. We previously analysed how policymakers lacked timely, granular tools. This is precisely the kind of instrument that closes that gap. You know, this kind of digital twin model is a brand new tool for understanding the economy. Traditionally, governments could only react to economic shifts with things like unemployment benefits after the jobs were already lost. But a tool like the Iceberg Index is a leading indicator, allowing policymakers to be proactive. They can now identify specific regions and job types at risk and design targeted reskilling programs before a crisis hits. We've discussed before that the two things to watch were official productivity numbers and policy responses. This gives states a way to move on that second piece with much more precision. The study shatters the common assumption that AI risk is confined to coastal tech hubs. Its simulations show exposed occupations are spread across all 50 states. And here's where it gets interesting. This suggests AI is creating new economic cold spots in states previously thought to be insulated from tech shocks. For example, the latest data indicates a 15% increase in AI exposure for inland states like Tennessee and Utah, much higher than originally expected. This could reshape regional investment and migration patterns for years to come. And this isn't just an academic exercise. State governments in Tennessee, North Carolina, and Utah are already using this data to build policy. We flagged a few days ago that policy responses would be the real tell. These are the early moves. The report's purpose is to give leaders a way to test interventions before committing billions, because the economic shift isn't coming, it's already here. When we place this state-led sandbox approach in the US alongside the strategies of other major economies, the contrast becomes clear. China, for instance, is using a more centralized industrial policy with its next generation artificial intelligence development plan. The European Union is taking a regulation first approach with its AI Act. This sets up a real-time experiment in which strategy scales faster. This all creates a real puzzle. Even with AI automating tasks worth $1.2 trillion, we might not see an immediate jump in economic growth. Economists call this the productivity paradox. A major investment bank, Goldman Sachs, forecasts that AI won't have a measurable impact on US GDP until 2027. This lag could frustrate investors and complicate decisions for central banks. The indicator to watch will be quarterly productivity data to see when or if this massive AI investment starts to pay off for the economy as a whole. Speaking of massive economic disruptions, the EV market is witnessing its own upheaval. While the entire European EV market just jumped 26%, Tesla's sales collapsed by a staggering 48.5% in October. This is where the situation takes a more complex turn. This isn't just a bad month. It's a signal that the entire EV market is fundamentally changing with the erosion of Tesla's powerful brand premium. For years, the name Tesla alone was enough to command high prices, but as more competitors enter the scene, the market is becoming commoditized. So the thing is, this could trigger a massive price war, squeezing profits for everyone. The electric vehicle giant is facing a full-blown crisis, and it's not just a temporary blip. For the year, Tesla's sales are down about 30% in Europe, a sign of fundamental problems. While Tesla's model lineup has grown stale, a wave of new competition is swarming in. In Europe, Chinese brands are entering with head-turning designs, and legacy automakers are finally hitting their stride. And the success of Chinese brands like BYD in Europe, it's actually a major test case for China's broader industrial export strategy. It's not just about selling cars, it's about demonstrating the ability to compete in a high-stakes market. This sustained pressure on European automakers' profit margins is already causing friction and could very well lead to more protectionist policies down the line. Just look at Germany's Volkswagen, a company that once openly worried about Tesla saw its EV sales surge 78.2% through September, selling triple the number of cars Tesla did. The success of VW reveals a crucial shift. The competitive advantages of legacy automakers like massive manufacturing scale, established dealer networks, and a wide variety of brands are reasserting themselves. Volkswagen's success is built on its modular MEB platform, a standardized base allowing them to efficiently produce many different EV models. Since 2020, they've delivered over 1.1 million EVs using this platform. This directly challenges the tech disruptor valuation that has long benefited pure-play EV firms. As one analyst put it, the problem for Elon Musk isn't just the Chinese, it's that the Europeans have finally caught up, and the pressure isn't isolated to Europe. In China, Tesla deliveries dropped to a 3-year low, falling over 35% in October. Even in the US, after a brief surge, sales cratered 24%. That 24% drop in the US wasn't random, by the way. It happened right after the $7,500 federal tax credit for EVs expired. This sharp decline reveals just how sensitive consumer demand is to price. It shows many buyers are making cold, hard calculations rather than being driven by pure brand loyalty. This decision to pivot to robotaxis and humanoid robots presents a fascinating duality. On one side, Tesla's core car business is under attack, while on the other, its leadership is focusing on long-term, high-risk R&D projects. It's a massive strategic gamble. Unlike software giants with stable cash cows, Tesla's capital-intensive car business is under immediate threat. This creates a high-stakes race against time. If the bet on autonomy doesn't pay off quickly or gets bogged down by regulatory hurdles like the ongoing NHTSA safety investigations, it could jeopardize the entire company. With sales skidding, analysts now project Tesla's global vehicle deliveries will decline 7% this year. The era of uncontested dominance appears to be over. So the big questions now are, first, will Tesla respond with aggressive price cuts, and can its profit margins withstand that? Second, keep an eye on the market share of competitors like VW and BYD. And finally, any news from regulators on the safety of Tesla's self-driving ambitions will be critical.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.